Hello. All right, thank you very much, and good morning, everyone. I'm Eric Osiakwan, and my desk is at Chanzo Capital. Today, I'm very excited to be moderating the pretty exciting panel. Three of my colleagues, and then hopefully Jason, the entrepreneur, will join us. We thought we will bring a mix of investors and entrepreneurs to look at the reality of VC investing in Africa. What are the trends? What's working? What is not working? Is the Silicon Valley model good for Africa, or is it an African model that will emerge eventually? So this panel is supposed to kind of provoke your thinking around the traditional VC model and how entrepreneurs are accessing capital across the continent. So I'm going to try and start with having the panelists introduce themselves. But with the introduction, just tell us where you sit in the VC constellation. Are you in early stage, later stage? Maybe some examples of deals you've done would be great. Andreata, can I start with you in Kenya?
Hi, everybody. Can you hear me? Okay, great. Hi, my name is Andreata Muforo, and I'm a partner at TLcom Capital. We're a venture capital fund investing in tech and tech-enabled businesses across the continent. We're fairly sector agnostic and really are looking for entrepreneurs that are solving some of Africa's largest needs in providing underserved services and leveraging technology as an engine of growth and scale. With that said, you find that much of the investments are around fintech, which is a large part of the investments that we make. So fintech, we've done commerce, we've done education, we've done health tech. So pretty diverse portfolio of sectors where we've invested. Our sweet spot is Series Seed and Series A, and I must say, generally, the market thinks we're later stage, but we're not. And I think part of it is because of the size of our fund. So our second fund was $154 million, and that's the fund that we're deploying out of now. And then also we have an ability to follow on. And our team, so we're Pan-Africa in terms of our mandate. In this second fund, we've made some investments. Our first one was Sub-Saharan Africa, and then the second fund we've now invested in Egypt as well, and are looking at North Africa because you cannot ignore, I'm sure, as someone said, you can't ignore that ecosystem.
That's a great segue to Egypt.
Hi, everyone. I'm part of the venture capital team at DPI VC, which is the venture arm of DPI. So you might have known of DPI. We've been around for 17 years, primarily focused on private equity investments. We have $3 billion of assets under management, and our portfolio companies touch over 40 African countries. So I'm part of the venture arm there. And over the past 5 years, we've been seeing a trend towards digitization, fintech, and earlier stage companies. And so we had the opportunities to back a couple of growth or later stage companies such as MNT Highland, which is a unicorn out of Egypt, Mukesh out of South Africa, and most recently MoneyPoint, which DPI led their latest round. So the transition or the opportunity to invest in these companies really symbolized the need for us to have a more embedded venture and dedicated venture strategy, and set forth the vision for us to become a multi-asset manager. So in 2022, we began exploring our venture capital strategy, and the venture capital team is mostly based out of Egypt, where I am based, and Egypt is a primary market for us. We have over $700 million invested there. And we're primarily focusing on fintech, early stage companies, and yeah, so we are focused on seed to Series C, hoping to back fintechs, across the continent, but mostly focusing on Egypt.
All right, that's great. So let's go to Maxime. So are you South Africa or France? Are you Europe or?
What? No, I'm Pan-African.
Okay,
no, but so yeah, on my side, I'm a partner with Catalyst Fund. We are early stage VC fund focused on probably the most important challenges we're facing right now as a civilization, which is climate change. And we back startups focusing specifically on climate adaptation and resilience. Very early stage, so stage prior to the likes of TLcom, so we invest at pre-seed. Often we are the first VC check in most of our investments. And to give you some examples of companies we've backed, here for instance in Kenya we have invested in a company called Octavia Carbon, the first direct air carbon capture solution in the global south. And we have also done Keep It Cool, which is a cold chain solution here also in Kenya. So yeah, that's in a nutshell what we do.
All right, that's great. So I'm going to try and probably start with you, Maxime. You have sort of a second life where you do the Africa. Oh, here comes Jason. Welcome, Jason. Yeah. So we almost skipped your introduction. So since you're here, I'll let you do it. Also because you're one of the sort of foremost entrepreneurs on the continent. And you say you're now retired. So I understand that retirees stay longer in bed. So now that you're walking out, let's get an introduction from the retiree.
So good morning, everybody. Apologies for being slightly late. In my defense, I was locked out of my apartment for a little while, but I'm here anyway. So like some of you, I think, in the audience, I was out doing advanced networking until about 4 a.m. in the morning, so,
That's why you got locked out of your apartment?
No, that was part two. So as you can see, I guess I've been fortunate to be one of the early people who raised capital, going back into 2011. Again, I was fortunate to see not only the capital process, but what it means to work within markets that struggle. To see investor, so Tiger Global is one of my big investors, to see how investor momentum, investor excitement can wane, and what happens when it wanes as well, right? So I think what I would hope to provide is a perspective from like an entrepreneur, old head, been doing this for like 15 plus years across Africa. Yeah, I'm not usually this late, but I apologize again. But hopefully I'll make it entertaining.
Absolutely, absolutely. You're welcome. Anyway, we're glad you're here. So I was going to start with Maxime. So you have a second life where you do Africa the Big Deal, where you've been doing a great job of just providing the data. You have a great database that looks at capital provision entrepreneurs. Sort of and I'm sure anybody who's not a subscriber to Africa the Big Deal here, if you're not, see Maxime after. But I think every Monday, or every month, right? Is it every week or every month?
So yeah, we publish insights every week or so, and then
Right.
there's the database update every month.
Right. So give us sort of the 2-minute sort of landscape of sort of where money is going, where money is not going, and then I want the other panelists to think about why is money going to certain places and why money is not going to certain places. And then Jason, I want you to think about your experience of somebody who's raised capital, built a great company, and at some point you struggled to raise money, right? Capital was not coming to you, and what did that mean for you? So Maxime.
Thanks. So just to specify, it's not a second life. Unfortunately, it's exactly the same life, and only have 24 hours per day, which makes it very challenging.
All right,
but,
great.
Yeah, so we track a little bit of data insights and curate data around fundraising, startup fundraising across the continent since 2019 or so. And so, yeah, just to give you a bit of a snapshot of what last year looked like in terms of startup funding in Africa, we were just at about $2.2 billion of funding, which was roughly 25% drop from the year before. That's a little bit of the bad news side. On the let's say more positive and optimistic side, the second half of the year, so basically from July to December last year was actually slightly on the upward front compared to the second half of 2023, so that's encouraging. In terms of concentration, sectors, geographies, and so on, very quickly, as usual, big 4 markets, so South Africa, Kenya, Nigeria, and Egypt were the largest recipient of startup funding last year. And I think it's probably the year where it's been the most concentrated, unfortunately. So I think we're at 84% of the total funding that went to these 4 markets. And after that, we have a couple of like runner-ups markets like Morocco, Tanzania, Ghana, and so on. But there's really still a big jump. In terms of sectors, it was basically fintech, unsurprisingly. I think it was 47% of the total funding that went to fintech. Of course, because our ecosystem is still quite small, it's only 0.6% of the global VC funding. Therefore, when you have large deals, it has a disproportionate impact on the total and on how things are split. So we had Moneypoint deal towards the end of last year that skewed everything towards fintech, 47%. Another sector that is growing, and of course here I'm biased because that's what I do on a daily basis, is climate tech. 32% of the funding went to this sector, which is a bit of a mix of energy sector, agriculture sector, some fintech also are climate tech. If you think of Pula, for instance, an insurtech here in Kenya, they are also focused on climate. So that's a little bit on the sectors and the geography. And the last thing to add a small insight also on what's coming up now. If we look at numbers of, the funding numbers for January was actually very high. We passed the $300 million mark, which was the biggest month of January ever in the ecosystem, except 2022, which is maybe a year that we should put in parentheses. So that's encouraging. We have a couple of positive signals, weak but positive for this year.
So I want to start with the weak point, so we go the other way. So 2022, we saw a big decline, 2022, 2023, right? And then 2024 to some extent. And towards the end of 2024, it picked up. Andreata, what does that tell you, or what's responsible for that? And I think that's the period that you raised your second fund, your new fund, right?
Yeah, so what's the trend that you've seen happen in funding in Africa is similar what also is happening globally, in terms of there was a decline during the period where interests were high, and there was a lot of pullback, especially of global investors moving back. If you look at the venture capital in the African continent, on the late stage side, it's mostly global investors that are investing there, and then also they carry the majority, right? If you think about the amount, so like what Maxime was saying is, you ended up with the Moneypoint deal and the Time Bank deal, which significantly skew, and that's typical of any ecosystem, that you have the big deals at the vast majority of the capital. So you find that in 2022, 23, there was a lot of correction around that, and there was a significant dip in 2023. My take on the data now, so the range, I guess the different reports, it's between 2.2 to 3.2 billion, which to me, my reading is there was a decline, but it's not as big as what we've experienced in the past. So I actually sense some level of stability. I think you can even see it with the energy within the ecosystem, that people are more positive. I think also even globally, capital is coming back. If you look at what's happening in India or in the US, there was an uptick in the amount of capital that's coming back. So I'm more hopeful and optimistic that we're actually stabilizing, and hopefully it will actually go up this year in terms of capital that's available to startups. I think the other thing to point is that there were a number of African funds that were fundraising last year and the year before, and it took longer because the capital markets were quite restricted, and many of them have actually closed their funds, so they're back in market. So that's also good, and that's positive for the ecosystem.
All right, great. Selma, so you did a deal that tilts things a little bit. This is the Moneypoint deal last year. What was the motivation? I know sort of DPI plays on sort of the higher echelons, and now you're on the VC strategy. So was it deliberate to tilt that you did the Moneypoint deal, or what was the motivation for that?
So my colleagues in the PE team are the ones who closed that transaction. Moneypoint is a great company. See a lot of innovative technology there, tremendous growth, and an opportunity for it to be a platform of services that can be that could service different African markets. So that's my understanding of the reason of why and what was the motivation behind leading that transaction.
Right. So Jesse, let me come to you. I mean, MoneyPoint is a Nigerian company. You're Nigerian. You've run Njoku for many years. Sort of, how does it feel to you when you started, one of the first people to raise money, and then at some point it was hard for you to raise money? How was that experience, and what do you think is responsible for sort of that pullback or that slowness in funding?
It's the macro, in the end. I raised money when Naira was at, initial money when Naira was at like 120 to a dollar. 8 years later, 9 years later, when we were out trying to raise money, and by that time we'd raised like $40 million. So we were fairly good at raising money at a time when people weren't raising money like that. By the time we were raising money, there was dual exchange rate mechanisms, and it was like 900 to like 1,000. Now it's 1,500, give or take, right? That is just, it's incredibly difficult to outrun that from a dollar sort of benchmarking perspective. What was interesting to us is our lead investor was Tiger. They essentially gave up on Nigeria. They were just like, anything Nigeria related, the macro doesn't make sense to us, we're out. But then they came back pretty hard in 2022. Just signing checks left, right, and center. So for me, it was quite interesting to see the waves of enthusiasm and what really changed from that. Because ultimately, from 2022 to today, the macro has done the exact same thing in Nigeria again, right? And I think a lot of the pause that people are seeing around the macro is that challenge. But ultimately, like, they were right. If I was just focused with my Nigeria business, I would be out of business right now.
And you did a terrific thing of pivoting very quickly in the middle of that to start looking at your diaspora customers. So were you too late in that pivot, or you didn't, so tell us that sort of.
No, so the funny thing actually is, so Tiger invested in us to build the Netflix of Africa, which is a streaming platform. So they saw it as technology. Very quickly, we realized that the amount of money we were putting into the production ecosystem, we were driving the cost of content to a place where it didn't even make sense to, we might as well just produce it ourselves. So we switched at the time, in 2013, from actually the bulk of our capital was going towards technology to the bulk of our capital towards going to production. And again, they weren't fully appreciative of that at the time. They thought that was a waste of money. They didn't understand the life scale, life value of content in Nigeria at that point in time. So by the time we were out trying to raise money in 2018, 2019, we had a big business, but 80% of that business was producing and selling content on Canal Plus, on DSTV, on GoTV, in Sky in the UK. So we were really good at monetizing content, but the streaming part was where we were losing money and struggling. So in 2019, when we went out to raise money, we spoke to a whole bunch of funds, etc. It was actually one of the big private equity funds. They were like, they looked at the business and they said, you know what, this streaming thing is not going to work. We've seen iFlix, Showmax, like everyone put money into them. But this thing you're doing with content, we really like this. So can you separate the two? When they separated the two, again, we looked at it all as one thing. We never really separated it. It was doing like $8.1 million in revenue, $3.4 million in profits. This is something we brought in like 5 years as a side project.
Right.
So they were like, we want to buy that. So we had a bidding process. Canal Plus, one of our lead investors at the time, they ended up buying that company, or at least Iwoko's shares in that company. My wife and Canal run that company independently now, doing incredibly well. And I guess why that company did it so well is all of their revenue was in euros and dollars. They negotiated with the big platforms, the big platforms.
Cost in Naira.
And they cost them in Naira. And more importantly, they will sign a 5-year deal and know that 5 years revenues in euros and dollars, everywhere's soft, right? So when we sold that, again, made some money, which was good, returned some money to shareholders, angel investors, etc. Everyone was happy. Then I went headlong into streaming. This is 2019. Obviously, by 2020, COVID happened. So at that point, we didn't necessarily need to raise any money because we had money. But then the Nigeria, at least, COVID happened in the West incredibly well. Nigeria, COVID, for content, completely wiped out, right? And I think even though Netflix, Amazon, etc., other people came into the market, no one won. So it's the market just didn't allow anybody to perform well, right?
I want to come back and continue on that because around that same time was when the Netflix executives came to Africa and South Africa. I want to consider, but I want to go to the investors and talk a bit about the macros, right? So currency depreciation, inflation, been very tough. Maybe I'll start with you, Maxine. So how do you deal with this internally as a fund when you look at first your portfolio and the companies that you want to invest in? Do you look at a macro environment, how much weight do you put on the macro environment of a country to determine whether you should invest in the company or not?
Yeah, that's a good question. I think we're all facing the same challenges here. I mean, at the fund level, the way we deal with that mainly is diversification geographically. It's quite hard to predict what's going to happen, and so therefore we try to balance our investments across geographies. The other thing is that, if you look at last year, macro were quite complicated in Nigeria, in Egypt, for instance, but those are markets so big that you just can't ignore them. It's just impossible. And so, at the end of the day, we go in it thinking a bit long term, because yes, if we just look at the past few months, things don't make sense. But we are not here to invest on a 6 months deal. We're here for 6, 7, 8 years, and so the bet is really on the long term here. And then the other thing we look at is the growth capacity of our companies. I mean, most of our portfolio companies in Nigeria actually had the growth last year in dollar terms. And so, if they are capable of growing fast, which is the case usually at early stage, that can outcome balance the macro challenges. But diversification is the number one approach, especially for some small fund like us. We cannot edge and so on. So
Right. Selma, you see it in Egypt, which has the same challenge, and you were telling before we came on that you've done most of your investing in Egypt. So it looks like you're more concentrated, or am I missing something?
So we are primarily focused on Egypt, and we see that, we go back to fundamentals, and we see the Egyptian market as a very resilient market. And that's where...
So resilience for you, the
resilience
of
for sure. It's been a crazy 24 months back in Egypt. Over the past 24 months, we've seen several devaluations, really high inflation, interest rates hiking up, some sort of capital flight, so a lot of global funding being pulled back. But even though 2022 and 2023, 2022, 2024 have been very hard, funding has gone down, deal count and activity has actually increased year over year in 2024. So that is also a testament to the resilience of the market. And I would attribute that to 3 main reasons. One, really strong local ecosystem. A lot of involved and strong local investors and not just global. So when times get tough and the global investors pull back,
Thank you so much.
Hello, can you hear me?
Yeah.
The local investors can support and are still there, and they do believe in the fundamentals, and they really do understand the market, and we always encourage global investors to also co-invest with local investors because they understand the nuances and the uniqueness of the markets, which is very important in the markets that we operate in. Second point is really strong local talent, specifically tech talent. A lot of engineers are still around and are building businesses and are keen on continuing and adding to support to startups back home. And then lastly, just the positioning. So Egypt is an important market geographically. It sits on the intersection between Africa and the GCC. So we see more and more of our companies themselves, they might be headquartered in Egypt, but they are diversifying by going into the GCC or to sub-Saharan Africa, more and more to the GCC, which has more stable markets. However, we do see some of our companies going, and we want to encourage more companies going towards like sub-Saharan Africa, etc.
All right. So resilience as a base for diversification into the GCC, but not into Europe. Do you see a bit going on to Europe or mostly to GCC?
Mostly to GCC. It just makes more sense culturally. There's the language. It's more homogenous. There's a lot of opportunity and growth, and I guess less competition there as well. And there's also a lot of liquidity. So in terms of investors and potential exit opportunities, it just makes more sense for these companies to go there.
So, Andreata, when you look at Kenya, sort of also the Kenyan shilling has struggled a little bit, but fairly more stable than Naira or the Egyptian pound. How does that play into your sort of approach? Although you're Pan-African, but you sit in Nairobi, so talk about Nairobi and kind of give us the broader, macros as you look at your portfolio.
Yeah, I mean, I completely agree with what my other fellow investors have said in terms of how you think about macro in the context of your of investing. I think also it's not also just macro itself; it's also political stability, right? Because those two are linked. I think Kenya last year was having a lot of cultural revival in that respect. So that also impacted businesses. So yes, the currency was stable, but you also found that there was a bit of a disruption in services as we had protests and the like, and people were voicing their opinions. So I think fundamentally, in the end, the way we think about it, also even at TLcom, is about having a Pan-Africa mandate and having that geographic diversification. And I know it's hard to expand geographically, and it depends on the nature of your business. But I think also, especially in Kenya, most businesses, unless you're Safaricom, you almost immediately have to think about another market, right? Because it's smaller than if you compare it to Egypt, if you compare it to Nigeria, right? So you almost always have to think about how do I scale this also outside of Kenya. There are some businesses, few, like Safaricom, that can just sit in Kenya and do extremely well. But I think the vast majority need to think outside. I think the other point is around also making sure that you're matching the currency of your cost and your revenues. I think we saw this a lot last year when the macro was shaky, is that many tech businesses use AWS, right? Their servers are being paid in dollars. But we also saw companies being more creative about how they think about their server costs and actually become more efficient. We have a company in our portfolio that halved the cost of their technology by just the way they thought about how do we structure our data and how do we save it. So I think also thinking a little bit around that is an important piece. But I think, yeah, in the end, this is our market. We're African investors. We believe in the opportunity and the potential of the African continent. I think also the other thing, it puts pressure on the founders to now grow fast. Like your growth can't be just 2x, right? You now have to go 3-4x in a year or over, say, 2 years, so that you can try fight some of the challenges you're seeing with the macro, because global capital is looking for a return. So they're comparing you to investing in India to investing in Brazil. They won't be like, oh, sorry, because you're in Nigeria, we understand. No, they're looking for a return. So it puts a bit of pressure, but I think the companies also have to be built tough in that respect.
Right. So Jason, I want to come back to you and pick up from where we left off. So nobody won. So do you think that it was more because it was too individualistic? Because during COVID, everybody was home and they should be watching, they should be on the screens. So what happened there?
In Nigeria, people were poorer. The cost of everything went up. I don't know, but the US, fine, everything fine. In Nigeria, people became poorer, like significantly poorer. In COVID, they closed the border, so food prices went up, inflation started to drive, like everything was thrown a massive handbrake at that point in time, right? I think I've been in West Africa for 15 years. Like, I've lived through Nigeria as an economy crumble. I've lived through Ghana as an economy crumble, right? So when Andreata was saying before that you got to grow at 3x, I was just like gripping my chair, because that just sounds like buckle up, it's some turbulence ahead. Because the challenge with going 3x is that you can't grow 3x profitably, sustainably. You have to do some pretty crazy ninja moves to do that, right? And someone needs to fund those ninja moves. So if your investors believe in that and they fund that, that's fantastic. And that was an issue that I had. Investors were super. In fact, they thought I was losing $100,000 a week, about $5 million a year. They thought I was not being ambitious enough. That I was being too commercial in some of these deals that I was doing. But I'm like, fine, give me $100 million and I'll go and make $100 million moves. But you can't give me 10 million and expect a $100 million outcome. So someone has to fund those losses. The challenge is, and I've seen this in so many cycles, in 2015, 2016, with the first group of VC-backed companies. I saw this in 2022, 2023, when investors just, for some reason, just stop investing. For the most part,
What does that tell you about the investors? You know, somebody says, I'll back you, and in the tough times, they're like, hey, idiots, you're on your own.
Well, it could be something as simple as your point person at the fund, he leaves, or she leaves. If your champion leaves, the next person, essentially, you're like adopted child. And as much as we like to think that they're the same, it's not the same. So if your champion leaves, you ultimately have a back foot there, right? And I think the challenge is almost all of our capital is not local. I think it's fantastic that more and more capital is originated from Africa. Again, Andrea, you will know that I spoke to some of the principals at TLcom when they were raising their first fund like many, many years ago. So I know how even tough it was to raise that first fund and et cetera, et cetera. So we shifted a lot in the last 15 years. But in the end, the investment cycles seem to be longer in terms of 7 years is not this market, it's probably 10 years plus. The liquidity isn't there. That has to be shown. So I think in the next few years, if the liquidity is not clear, then I think that will calm a lot of sort of the further investing. For me, again, I'm 44 now, so that youthful enthusiasm, that agency, I don't have it anymore. So on I will never raise venture capital money again. Because in the end, I feel that I've got high net worth individuals, we'll bring some money together, let's do something. So the 40 million, and I've said this many times before, the $40 million that I raised from Tiger and Shineverk and like Canal Plus, with what I know now, $5, $6, $7 million, I would have done the exact same thing. It was that grow at XYZ, do crazy moves, that was where that massive difference came. So I think capital efficiency is in vogue now, which is amazing. Sustainability is in vogue now, which is amazing. I think the challenge is a lot of entrepreneurs don't have portfolio construction, can't massively diversified. It's, I invest my entire life in this thing. If it doesn't work, then I'm basically screwed, right?
Yeah.
So.
But that's to the point that, so as an entrepreneur, you have to now respond to the core discipline, right, of sustainability. You need economics, looking at profitability and not just investor money at all costs and, you know, growth at all costs, right? So you would do it different
Eric, and I'm sure you as investors have sat down with your people and said, okay, how do we need to get 3x? If you're doing 3x, 5x, I've not seen that done sustainably without burning money, because if they could do it sustainably, they don't need venture capital.
Right.
I've met a lot of founders who are doing $7 million in revenue, $5 million in profits. You can't give that person money. What would you bring to that table?
Right.
You understand? So I think there are some amazing companies which are out there which are incredibly profitable. They don't necessarily need venture capital, but there are ones who want to grow because there's a massive opportunity there that everyone sees. Usually it's not the entrepreneur who is driving those loss-making conversations from my experience. Maybe it's changed, and maybe I'm just a bit old, but I guess investors have a big pull on
Andreata,
that.
you want to chime in?
Yeah, I mean, I
Are
think...
you driving these conversations, or how do you deal with this tension with your founders?
Yeah, it's an important tension. I think on one level is the fact that you're fighting against the macro, right? So, like I was saying, capital needs a return in order for it to come back. So maybe the question then is, maybe that business or that space is not venture backable. So we have the wrong type of capital that's there. But to say, but it'll be impossible to think we can sustain the capital coming into our continent if we're not able to bring returns that match kind of what people, like investors, are seeing globally, because they are seeing globally. So I think there are these macro challenges that we see. So, and I think it begs the question of, okay, so then yes, not every space is venture backable, and we need to like look at it with that eye in mind, because it should never be about wasting money, because you can't be buying growth, right, as we've seen. So it needs to be sustainable in terms of the growth that you're experiencing, but perhaps the space, the vertical, the model is just not ready. And when you think about companies that, end up failing or don't do well, which is fine within a venture context, right? Because we know that some companies will not make it. And so understanding why companies are not succeeding. I think there's an element of it, or for some of them, that the market actually was too small, and that's a big part of it. The timing was not right. That also plays out. So I think it's part of the learnings in terms of, okay, so then where should you channel VC money in Africa so that we actually continue to grow the ecosystem? Otherwise, it won't grow if there's no return.
Right. So you hit on the next point, which is cycles, right? So Selma and Bayen. So maybe I'll start with you and I'll go there, or whichever way. So when you sit back, where do you think we are in the cycle in Africa? And cycle in terms of sort of the ecosystem across the continent, but cycle in terms of now you can talk about your portfolio and how you invest vis-a-vis the countries in which you are. How do you look at timing?
I think the cycle sort of reached the lowest point over the past 2 years, hopefully, and with pickup. There was a period of growth at all costs, peak valuations, a lot of easy cash that was readily available, and now that's not the case. So founders and investors took a step back, had the opportunities to perhaps pivot, ensure that the business models actually make sense, be more prudent with their cash, extend their runways, and the companies that sort of made it past that phase are the ones that are really primed for the scale and growth, and have the opportunity to just have a more focused vision to go beyond. And that's what we see with our portfolio companies. And just to add to where we are in the cycle, I mean, a lot of the research that's been out is showing that there's a lot of early stage activity, but in reality is, at least what I see on the ground in Egypt, we do see a lot of mid-stage deals and oversubscribed mid-stage funding rounds. So perhaps the data is lagging from 2023 deals. So for 2025, we see perhaps more structured, larger deals, and investors sort of signaling the fact that they want to double down on proven business models and companies that are ready to scale.
Right. So I'm going to come to the audience questions. I'm going to let Bayen and Jason chime in. But Bayen, I want to point on an article that came out late last year about exit. I think it was Adarin that wrote the article. I'm blanking on the name a little bit, about where we are in the cycle. And his argument was fundamentally that we're getting to the point where we should begin to see a bit more exit. We're getting to that exit window as a continental cycle. And I guess sort of that's the big elephant in the room, exits, right? How do people make money? How do you return capital? And Jason, I want you to tell us from an entrepreneur's point of view, you return capital, how much did you return? And those who didn't get money, how did they respond? Bayen.
Yeah, now happy to talk about the exit point. Just a quick addition on the cycle point. I think if you look at what we have been through in the past couple of years, now is probably one of the best moments to invest in the continent in terms of valuation correction that has happened, capital that has been closed by a number of funds, and the amazing talents that we have right now with a little bit more established pipeline and so on. I think the momentum is really, really great, especially in our space in climate tech, we're really seeing that. To your point on exits, you're right. I mean, if we look back, at the couple of exits we had, the known ones in the past couple of years, you take the Paystack, the InstaDeep, and so on. On average, it takes 10 to 12 years, right, between launch of the company and exit. So if we want to think a little bit about what kind of exits we'll see now, we need to look at which companies were created basically in 2015. And the reality is that if you go back to 2015, with some few exceptions, there were not that many startups being created and not that many early stage investors to back them. And so, but 2015, 2016 is when things started to accelerate a little bit. So yes, we should be in the years now where we will see more and more exit normally. I mean, if we look back since 2019, we had about 160 exits, different kinds of exits. I mean, not all of them were very successful ones, but they are happening, sometimes at early stage as well. And so, yes, in terms of timing, we should now be at the point where we're going to see more of these. And yeah, definitely looking forward to that, because that's initially why we're doing this. Yeah.
Right. So Jason, incredible stuff you've done. You raised some of the early funds. You returned money early to your investors, and you are retired now. What would you tell your young self? How would you do it differently?
So I think a couple of things which I think Maxime picked up on as well, right? One is early investors and myself, we made money. The actual venture capitalists, Tiger, Shinavik, they didn't make money.
Why?
Because the streaming service that they focused on didn't work. But during that process, they were doing, and you're seeing it even today. You see angel investors getting taken out. So my angel investors put in $80,000, took out $2.4 million. You understand? So that still happens today. You see, I think We Capital, returned their fund off an angel investment.
Yeah, but to be fair, also, angel investors lose money. They have a 9-to-1 ratio.
No, that's fine. But at least in terms, if you look at, to my understanding, if you look at the liquidity, there aren't many big actual final, this company is being sold to a new owner. Most of the liquidity is happening at Series B, Series C, like PE level. It's not your typical, it's not, if that's the nature of the liquidity you're going to see in this market continuing, then the venture capital system doesn't simply work, essentially, right? So I think my perspective is, and I've encouraged for the last 5 or 6 years, any person who comes to me, raise as little money as you can, still be ambitious, but be ambitious with being as capital efficient as you possibly can. And we've definitely seen over the last couple of years, something as simple as, and with the AWS thing that you talked about, AWS tried to kill my business. I'm not sure they're here and we love them, but it's because we were not efficient in how we were structuring our data systems now. Everyone used to use Gmail, everyone now uses Zoho. You see Zoho billboards everywhere, right? So you look at your dollar cost, you look at your Naira or your CD or whatever exposure, you become more efficient. So that has nothing to do with your ambition, it's just how efficient are you being. So I think, not to my younger self, because I made all those mistakes, to the new generation of young people who have agency, just be as super capital efficient as you can. You can be super ambitious,
but be super efficient as well.
Absolutely.
So super ambitious and super efficient. And we'll take some questions too, hopefully. Sorry we stay here a little bit longer, but hopefully we can get 2 in.
Anybody?
Am I seeing anything, or you want us to keep going?
Okay, no questions? Okay.
Oh, one here. Terrific. Oh, over here too.
Yeah,
All right.
hi. Maybe just to follow up on Jason.
Quick introduction, please.
My name is Oke. I'm with XSML Capital. We're a private credit firm. So the question following Jason to the VCs, is there still a play for VCs then? What's
Good
your
question.
reaction to that?
It looks like we've pretty broken the VC model on this conversation. So is there a VC model? Selma, do you want to start?
Yeah, I mean, there is, but the cycle is just much longer, and there has to be a deep understanding of the markets that we're operating in. You need to understand that there is volatility, that the currency could sort of, devaluation could wipe out a lot of the growth, and the fact that you have to be even more capital efficient. I mean,
You have to be more capital efficient.
African founders are hustlers. They really need to be creative because they're not just facing the typical challenges of entrepreneurship, but also the additional uncertainty and macro. So investors need to have, in addition, deep understanding of the models that they're investing in, but also understanding of the markets, and the cycle is much longer. And should encourage more capital efficiency and for founders to become more prudent with their cash.
So founders, you become more capital efficient. But Andreata, I want to make a quick one, and then I'll come to you.
Yeah, I think the other thing around the VC math is that there is an expectation that, so within a portfolio of company, you know that a portion will not return capital. Of course, you shouldn't know that when you invest, but over the life, like how it plays out, a third, like, you know, a portion will not return capital, a third will be okay, and then you have a few that become kind of the outliers that are able to help you return the fund and return the capital. So that's the VC math, different from private equity, where you want each of your companies to bring back 3x, and none, if any, one can fail. But there is flexibility within the VC model to see some companies that won't return capital and the ones that will. And I think the way you can also see, okay, is there an opportunity for the big winners that then will be able to help you return the fund? You can also look at I guess there's some signals. So if you think about some of the unicorns that you're seeing that are coming up, I think that's a signal. We're getting more and more of those. So if you have, say, 2 or 3 of those within a fund, you're able to return a fund. So the model works, and it's also normal that some companies will not make it.
All right, thank you. Can I beg your pardon that we sneak one in? I know our time is up, but gentleman has been waiting. Sorry about that.
No worries, thank you. My name's Timbo Drayson, co-founder and CEO of OK Hi. Our mission is to put 1 billion people on the map. I'd like help with the strategy question, which I find very, very challenging. 95% of our business is in Nigeria right now, and the key question is, do we keep doubling down on Nigeria to try and prove out our unit economics, product market fit, network effects? Or do we diversify, because our product does work anywhere in the world, into other markets based on the macro situation in Nigeria and the risks around it?
I'll let Jason take that, and then I'll try and wrap it up. I'm sorry, guys, but...
Sorry. Fantastic question, actually. So I'm in Dubai now. I've done 15 years in the continent. I'm now sort of like settled in Dubai. And what I found there being there like 10 months is, one, they're so similar to at least West Africans in terms of their lives, informal, et cetera, et cetera. But the key thing for me is just the stability and the ability to monetize everything there. So what I spend a lot of my time doing, actually, and Andreata we're having this conversation, Eric, we were having this conversation yesterday, is I do as much as I can to strongly encourage African founders, come and try and at least use the option of GCC as opportunities. I was in Riyadh earlier this week. They are throwing money at startups just to come and incorporate and to build your MVPs and to expand in the region. In UAE is exactly the same thing. So between Saudi Arabia and the UAE, they're pouring money there, and there's huge amounts of liquidity happening in those markets. So for me, it's you can build startups in hard mode, which is what you're doing in Nigeria, or you can have things a little softer in GCC and Dubai and places like that. So I think what you are doing is amazing. If it works anywhere else, try and make it work in a place which, at least in 10 years' time, the currency will be the same. Yeah, you can actually monetize it. People are willing to pay for it. Because almost all of the issues that I see people solving in Nigeria, they still exist in Dubai. Banking, like credit, all of these things are still problematic. It's just that other people are solving them for other markets and stuff. So my view is that if you're going to diversify fast and diversify to another emerging market, which is pretty strong as well.
In other words, add other geographies, not leave the existing geography to somewhere else. Is that what you're saying?
No, I would leave, but that's just me.
All right, Jason is left, but not everybody has to leave, right? On that note, I want to thank can we give a round of applause to the amazing panel and to the audience? Thank you so much. Sorry we went over a little bit, but I apologize. Thank you so much.